We all go to cocktail parties, and there's always that one person that likes to bring up the topic that really nobody wants to talk about. And they always make the party a little less comfortable. Well, we've all been told don't talk about those main hot button issues, but today I'm going to be that person. I'm Scott Carter, CEO of PM Capital, and the topic I'm going to bring up is the pension crisis. You might be saying, what? What pension crisis? That's right. I don't have a pension anymore. Maybe you don't have a pension, but there's a pension crisis. And the pension crisis exists with our government employees. We're paying taxes, and the government employees are still getting pensions that really were eliminated in the 80s and the 90s when we were working at private companies. The government employee's pension is very lucrative, but it is not accurately funded because the U.S. government and the state governments aren't required to really use traditional accounting methods to put the money away. As investors, this is a huge risk and exposure that's coming down the pike that you need to be aware of. So let me give you a little background information. The pensions in our states, our municipalities, I'm talking about teachers, firefighters, government employees, federal workers, all of them, this pension they're counting on is significantly underfunded. Today, it's underfunded in their definition by over $2 trillion. That's a huge number, and it can only come from tax revenue. What politicians aren't telling you is that that $2 trillion estimate is based on bogus accounting. What do I mean by that? The pension funds use a discount rate or an expected return on their portfolio for the next 50 years of 7.5%. Now the reality is they've only achieved 3 to 4%. So if you use the real number, the pensions are underfunded by over $8 trillion. In my view, this is a crisis that's going to hit in the next 5 to 10 to 15 years, and it will be something that really is a dividing issue in our country. Because you have taxpayers that work in the private sector that don't have pensions, that have to pay extra money for government employees or state employees that do have a pension, and it's well underfunded. Now, as investors, we need to be aware of that. We need to know that coming down the pike is a liability that one of two things has to happen. Either the government has to come clean and they have to minimize or reduce what the pensions will be for these employees, or they're going to have to come to the taxpayer and say, we promise these pensions and we need you to pay more taxes to cover it. Either way, as investors, we need to account for it in our own investment thesis and our portfolio. What I would recommend you do is that you have assets that are outside of the basic dollar-based system, physical assets that are finite. And as taxes are raised or as dollars are printed, those assets tend to go up more. Gold and silver, which is the business I'm in, have historically been that asset of choice. It's a safe haven asset. If the dollar declines in value, generally speaking, gold and silver go up in value. Most investors don't have any gold and silver exposure in their portfolio. If they did, they would have a nice hedge against this risk factor of future liabilities and future tax payments that the government's going to have to pay either through additional printing of money or tax revenue. So as investors, if you don't have gold and silver in your portfolio and you think that the debt crisis and the pension crisis are critical, then maybe you should reconsider it, get the information, and see how gold and silver can be a great ballast or a hedge in your portfolio for future risks and future liabilities. Call us now, get the information, or click on the screen and get the information to find out if gold and silver is right for you.